I've had a recent customer who unfortunately has made like 20 inquiries, right? So he's made 20 inquiries to credit cards and personal loans and whatever, he's trying to get a new car. And he hasn't taken any of those loans, but he's inquired so many times that it's impacted his score down to 487.
Wow.
Just being 1 point below 500 is an automatic decline for a lot of lenders. Unfortunately, the way that the credit score system works in Australia is all of those inquiries, every single one is dropping his credit score down lower and lower and lower. Credit scores are super important, especially here in Australia, and it massively affects, things like your borrowing power and which lenders you can go to. And the ways that we assess it here are drastically different to other countries. Can you just sort of explain to our customers and the audience watching the video how a credit score is treated here and how it can affect your rating?
Absolutely, Ross, definitely. In Australia, what impacts your credit scores is the inquiries that you make and your ability to make repayments. Some lenders are classified as good debt, and then there's some debt that are classified as bad debt. So good debt is like when you apply for home loans and you're able to meet those repayments. And there's also bad debt, like applying for credit cards and also like buy now, pay later sort of arrangements. The more inquiries you make would also impact your score. That's because, if you're making more inquiries, the lenders might see it as, why is this person making so many inquiries? Why are they knocking him back? Or is he really in a financial, hardship that he needs to apply for credit cards and these sort of services?
Yeah, I think like coming to a broker as well, we obviously do the credit check before you even submit it to the lender, right? So I've had a recent customer who unfortunately has made like 20 inquiries, right? So he's made 20 inquiries to credit cards and personal loans and whatever, he's trying to get a new car. And he hasn't taken any of those loans, but he's inquired so many times that it's impacted his score down to 487.
Wow.
Just being 1 point below 500 is an automatic decline for a lot of lenders. Now, there are lenders that will ignore and they don't do credit scores because technically the guy's never missed a payment on anything. He's just made lots of inquiries. Unfortunately, the way that the credit score system works in Australia is all of those inquiries, every single one is dropping his credit score down lower and lower and lower. They want to see people that are applying for one personal loan, taking it out, meeting the repayments if they're taking one out. They want to see a car loan, just one inquiry. The minimal you have on your credit score, the better it's going to be. And the better it's going to impact, your score at the end of the day. And the higher the score, the broader your lending capability is, essentially, with a lot of the lenders.
Absolutely, I understand. I actually had a client that I did a credit report for him as well, and he found some things that he wasn't even aware of. Like, I think he was a victim of fraud. There was multiple inquiries to phone companies where he made multiple inquiries, and that really lowered his score down. The way I help this client, there are options you can do or services that you can go to fix your credit score if that does happen to you. And you can also download a free credit report if you like by going to mycreditfile.com.au.
There's two things, right? So if you've made multiple inquiries and you're at, 15 inquiries on your credit file and your score dips below 500, the problem is a credit fix team actually can't fix that. You have to patiently wait for that score to go back up. If you've got a default on your credit score, chances are that we can send it to a credit fix solution company that will be able to fix that and turn that around within 60 days or 90 days or whatever it might be. And we can get that score back up to the 700s or the 800s. Like, there's just no solution really. If you're making too many inquiries and that dips below the 500 mark, unfortunately you're going to lose a lot of lending options. Now, the good thing is if you do have defaults or you have made lots of inquiries, there are alternative lenders, tier 2 funders, tier 3 funders that will still give you lending and borrowing power. So if you have a strategy that's fairly aggressive for investment, or you just want to enter the market and get on the ladder but your score is hindering you, there is lots of options. And we've done deals in the $2, $3, $5 million bracket with people that have credit issues, and we've managed to take them to these alt doc lenders or low doc lenders or lenders that don't check credit scores. And these are essentially what we would call stepping stone lenders anyway, right? So they're going to stay with that funder for up to 2 years, maybe 3, and during that time, once their credit score reaches the sort of mark that we need them to get to go back to a big 4 lender like Westpac or ANZ where the rates are much, much better, then we'll move you across. It is a sort of a bit of short-term pain for long-term gain, but it allows you to enter the market with, a poor credit history or a low credit score, wherever it might be.
Awesome. Is there any other ways to improve your credit score, Ross?
Try not to make as many inquiries as you do. Make sure you're meeting all of your repayments. If you do miss a repayment and they send you one of those emails that says, we're going to try again in 3 days' time, make sure you have the funds in your account for it to come out. It's not necessarily a missed payment that will impact your credit score. It's when they retry a couple of times and then it goes out as a full-on default. So it's just making sure that you're staying on top of your bills. And I know it's painful, but if there are issues, you do need to pick up the phone and either talk to a broker or talk to the company which is trying to get the funds to negotiate with them about getting it paid. Going into hardship is another strategy, right? So a lot of people, the interest rates are very high at the moment and you're coming off that mortgage cliff. If you are at a point where you feel like you're going to miss repayments, you are best to call the broker and the lender to discuss, because you do not want the bank to take hold of your property. You're better off selling it yourself. You just don't want to go down the rabbit hole of missing a repayment. Right. It just destroys your capability to refinance to any lender. Yeah,
absolutely. Now, we covered that, I guess, the credit score side of things. What else can affect someone's borrowing power, or how can you increase your borrowing power?
Every single lender has a different borrowing power limit, okay? So, the big four, tier one lenders, we'll call them, the Westpacs, the Commonwealth Banks, the INGs, the Macquaries, the things of that nature, they'll have what's called a 3% buffer. Mm-hmm. So when we're doing borrowing power calculators for customers, those lenders aren't testing your borrowing power on the 6.2% interest rate. They're testing it at 9.2%, and they're making sure that you can meet the repayments if there's a 3% buffer, right?
Just in case something goes sour? Right?
Just in case something goes sour. Also, they've got different levels of expected expenses. So if you're a couple with 2 children, each bank will have its own, what we call HEM, which is the estimated living expense, right, for that family. So some HEMs are lower, some HEMs are higher, and that also impacts your borrowing power. So just for example, ING has quite a high HEM and quite a low borrowing power, but they're very good for what we would call a vanilla customer, which is, high paid, low debt. They're very good. But if you need further borrowing power, there are other funders that are what we would call our tier 2, tier 3 bracket, and they assess completely differently. So they only have 2% buffers, 1% buffers, and actually in some cases no buffers at all. So there's actually options for fixed rates over 5 years where there is absolutely zero buffer at all applied to the calculator. So it boosts your borrowing power significantly. Also, credit cards. I think a lot of people will have these inquiries and we'll be on the phone, they say, look, I have got a credit card, but I don't use it and there's no money on it. And the problem is the lender doesn't care if you use it or not, they care about the limit on the credit card. So if you have a limit on a credit card that's $15,000, but you don't spend anything on it, the bank will, times that limit by 4 or whatever their calculator states, and they will reduce that from your borrowing power. So just getting rid of a credit card that's say $15,000 could boost your borrowing power by 50, 60,000.
Wow.
So that's another example. Personal loans, car loans, anything of that nature, we can guide you if you've got savings or money in your offset facility from another property to maybe state, okay, we need to pay down this personal loan, we need to get rid of this car, or the novated lease is extremely costly and we need to rework this. So these are all different ways that we can assist with your borrowing power.
Oh, awesome. Now you mentioned like buffer rates and HEM, right? Do these rates change all the time, or are they always the same with different lenders? Or?
Okay, so I think we're moving into a climate now where rates are going to start reducing.
Yeah, I mean, like the cost of living is increasing, right? So do the buffers increase with the cost of living? Oh.
Let's just use one of the mainstream funders as an example, ANZ. Okay, so let's say average rate with ANZ is 6.2%. They're buffering you at the moment still at 9.2. What we are starting to see is a trend with the banks, and they're bringing out some products to win market share, is they'll bring out products that have like 1% buffers for refinancing, as a good example, right? Or If you can move to that lender and the repayments are less because you're going on a smaller interest rate, there's like no buffers at all. So these are like special refinance deals that are available. But I think what we will see in the future, as rates start to come down and there's confidence in the cash rate coming down, is the buffers will reduce with the lenders as well, giving people more borrowing power, because they know that the future projection is going to be the rates are coming down, therefore the buffers come down as well.
Now, if someone's looking to buy a property, do you have any advice for them, like leading up to the transaction or leading up to when they speak or approach a broker?
So I think you've got to know your basics, right? So what you're earning, what your liabilities are, and a bit of an idea on what your goals are for the future. One key thing is you don't need to remove your debts for borrowing power to gain pre-approval. These will be conditions. For example, if you do have a credit card that's $20,000, you don't need to panic before talking to your broker and cancel that credit card, right? You can apply for pre-approval, get the pre-approval in place, and it will be a condition that that credit card is closed once you've found a property. So you don't need to do necessarily all the things initially. I feel like a lot of people, they find that they need to get themselves too ready, and you don't need to be too ready to talk to us and get a strategy in place. You can get a pre-approval and get ready to go and engage a buyer's agent if you're using one, and have things as conditions as part of your pre-approval.
Okay, that sounds good. Do you have any final tips for anyone out there looking to increase their borrowing power?
Don't overthink it, talk to a broker.
Awesome.